Is labor market that hot that it may melt even the permafrost in Alaska and dress Eskimos in bikinis? Can Mr. Powell therefore be treated as a hero when talking about steadiness of economy? And taking in consideration all of that, what about all leading indicators that are feeding us with hopelessness scenarios regarding economy? So, analyzing all of those mixed signals, I'm inviting you for another dose of news out of Blockrevision. Today's transmission is live, so don't forget about popping the questions in a chat that would like to be answered. And if you enjoy, always hit a like button, or if you don't, just dislike. I won't bear a grudge. So without any further ado, let's head on. So economy view is the first section that gives us a macro outlook in order to get better approach for investments and inside of trading sector. So what happened to yesterday was this second meeting with Powell that decided to take much more water yesterday than he took on Tuesday. So after yesterday's meeting, the moods along the Wall Street has been a bit more chilled out. So after Tuesday's speech, the market got really nervous, right? So we could find that the Fed probability rate of hiking interest rates has risen to 75%, and right now it has come down a little. If we just jump right over to this data, we'll find out that Fed probability rate and countdown is right now at still 77.9. So the market didn't really chill out. I have found previously that it did, but right now the moods are much more one-sided than it was even yesterday. So it has right now leaning towards the scenario where this 0.5 interest rate hike might be out of the question. And even though the 0.5 won't take place on March, it undebatably will weigh on the dot plot characteristics that will be released right after it. And this dot plot also inflicts the whole structure of how the interest rate cycle will look like and when this rate cuts may eventually appear. So looks like this cuts might be pushed for even further, and that's why the market getting more spooked than it was before. So we had also been listening to what the Beige Book was telling us, and we have found that taking consideration the different point of views, no uniform picture for the whole country, but some regions might be more susceptible to a hard landing. So the outlook right now it points that not the whole states, not the whole United States might get indulged in this very doomy outlook of an economy, but some districts that are more prone to such circumstances. So partial hard landing can be can't be put off the charts, and many firms across the country indicated persistent price pressures, and the other might be abating, but we can find that those districts that are most suffering from these supply chain issues might be the one that may slump in this productivity gauges that may appear this or next quarter. So we can find that many of elements suspecting that labor availability is improving. It eventually leads us to a conclusion that finding workers with the right skills is still challenging. So there are not maybe much of indicators that are finding out that this labor market is cracking already, but we may find that some of elements already starting to fall apart, and that's exactly what I'm talking about. This cumulative global layoffs. So at tech companies, we can find that after this very robust period of pandemic time, where throughout 2 years the employers were acquiring new workers at mass. Right now they are laying off. Yeah, I don't know, that's a kind of an adjustment to the new reality that came across, but we can find that this pace of layoffs is really outstanding, and I may push it to that AI might be the one that may replace that type of massive layoffs, but in my point of view, that's too early to say that AI will be the one of a replacement force, as it's too early, and this technology is not prepared for such a layoffs of peeps. That's why we can find that in order to boost the productivity, we would expect another wave of hiring, but possibly in another market cycle, as right now by this rising costs of running a business due to hiked interest rates. It's right now of the charts, and average weekly hours right now are pointing that we might be somewhere at the inflection point of this leading indicator that's also showing us how resilient the market, the job market really is. And right now, after giving us an outlook of this falling tendency, we might have found it right now. It might be a similar situation to that pre-pandemic of 18th and 19th, and we may find it another slide downwards might be visible by some kind of recession time ahead. So it's very important to watch, and also that's another gauge. Even though we are talking about that labor market, at least some reports showing us that it's this sector very steady. We can find that, for instance, this statistic that depicting that hiring is down 27.9% in February 2023 from last year is really causing a shock and awe among many job market analysts. So LinkedIn came out with this latest workforce report, which shown us that meaningful slowdown has been noted in 2022 and 2023. So the unemployment rate by some means is ultra low and surprisingly sticky, but the possibility that it will eventually start to buckle can't be ignored, particularly as corporate layoffs news remains ongoing. So that's why we'll get you updated on the case, and the labor market is the one that Fed is glancing at when taking its decisions on interest rate hikes or cuts. That's why we need to cover these elements. So leading economic indicator has peaked in 2021, and we could find it, given the recent tendency for a lengthening in the onset of recession, a 21-month lead time equates to a September 2023 peak in the economy, and which is a 6 months away. It's relatively long, but it's just as we can find falling for third quarter of this year. And monetary policy works with long and variable lags. That's important to notice. The Fed is on track for more rate increases. That's why the economy should slow, and it tends to do so suddenly and quickly if that happen. So this LEI index is prepping us for such an outcome if history may repeat. So that's why I would expect that this verge of 2023 and 2024 might be much more turbulent for the economy than what is right now. What about the market outlook, you may ask? And let's find out about the most interesting index by global terms. So it's S&P 500. So if we just turn on all those lines, we can find that we have rebounded out of this 39.2 hundreds, and right now we are trying to rebound out of this level of 39.7 hundreds. We can find it at 4-hour chart. We have built an exhaustion candle that has coincided with a rebound been followed, and we would expect that it should be somewhat a power to push it even higher. But for now, we would expect rather more consolidation than fiercer rebound out of here. This range of around 39.8 and 40.2 is expected to consolidate for a price. In terms of US 100, we can find it. Oh yes, that's a very interesting rebound, and we can find it. US 100 didn't manage to get downwards to test out this lows of 12.06, and right now we are relentlessly heading to testing out another resistance of 12.3 hundreds. So for US 100, it's right now a bullish. What we find as bullish, and that might be a power to push the price even towards a recent highs of 12.8. So in my view, the most important indexes are bullish alongside DAX, that is a German index right now, showing an enormous strength after defending those lows at 12.21. So that was indexes right now. Let's find out two other news out of crypto this time, and we will find out what is happening with the event that was shaking the market back in 2022. So many of culprits of the market burst in 2013 and 2014 was those founders of Mt. Gox. So Mt. Gox has literally hacked investors and traders that were storing the cryptos on exchange. And right now, the largest creditor of the failed Mt. Gox crypto exchange intends to hold rather than sell the Bitcoin that's due to be disbursed to it this year. So many of those investors that has suffered from this Mt. Gox fallout has been battling for restoring the wallets by this time. It's already 10 years and they haven't regained this already. And we can find that this retrieval may happen even in a more postponed manner that it was expected previously. So that's why as we are postponing this retrieving period, we may find that this supply of bitcoins that might be released shouldn't flood the market this year, possibly. But we have this 10th of March time span to decide, and that will be very important to find out whether it will eventually been spilled over or rather pushed back and pushed to another date in the second half or even next year. So it looks like the Bitcoin and crypto is right now in an unstoppable phase, and those news here is the one that may justify that it may get a even stronger momentum with weeks to come. All right, what about the market movers? Let's find out what's going on with economic calendar, and that's the one thing. And that's the one thing that is right now pushing the highest interest of the market, is that Friday's event of non-farm payrolls just remarked that date Friday 8:30 East time, and that's the one that may cause the largest volatility. What about the Wednesday? So yesterday we were talking about job openings, net expected levels out of United States, and inflation rate out of China at 1%. So it means that China is ready for stimulus to boost economy even further. As we can find that inflation rate was the one very strictly observed by those policymakers that are in charge of this Chinese economical structure, and we can find that this inflation rate that lowered might be the one of the topic that may favor more loosening on the way in order to regain the Chinese economy a traction to thrive in this 2023. So those are the most important elements, and let's find out about earnings calendar. Today we are dealing with Oracle Corporations and JD alongside DocuSign and Gap among the most important. Also, Ulta Beauty is the one to watch. In terms of Oracle, recently we've seen there was a such shaping up earnings per share, and it means that it has slided recently, but right now we are expecting this one to rebound. This earnings per share at 0.94 is of high interest and high expectance, and that's the one that may be met on Q4, as a majority of technological stocks are beating the expectations. All right, what we got next is obviously trade idea. So for trade idea, I have for you a similar, or I would even say the same tip as yesterday, as nothing has changed. XPD to USD, so CFD on Palladium is the one that you may expect, considering in terms of trading. So right here we can find that Palladium has slided yesterday after this bet against on yesterday's transmission, and we have slided right off that window by even up to 4.42%, and nothing has changed recently, as we are still in a drawdown mode, and every single wind up, every single week up to levels of 13.6 might be treated as the one of a possible starting point for another downward move. So for this type of projection, I would set my entrance box to the levels being limited right here by 13.5 and 13.6, 13.63 and 13.54 relatively, and that's the box within which I do expect that this risk-reward ratio is the highest for now. I do expect that Palladium will slide to 12.7374 within next sessions, and I do find that still this risk-reward ratio at 3.97 is still worth taking a risk. In terms of fundamentals and where the commercial is, and why am I playing this type of bet, you may find out in the previous episode about Palladium especially. So I'm inviting you to find out on a Blockrevision on YouTube. So as I mentioned yesterday, remember about proper management of your risk and always take the risk according to the one you are most afford to. So in my view, that's it. Thank you very much for sticking around. That's another episode that already has been published. If you haven't caught up today, tomorrow at 8:45 a.m. East time, we may get another dose of updates of the market. That's why I'm inviting you already right to that episode. And thank you for today, and see you